This is Nightly Business Report with Sue Herrera and Bill Griffin.
Bulls in control. Stocks rally on solid bank earnings, positive data out of China, and a big energy deal, sending the S&P 500 above a key level for the first time in 6 months. Big reveal, Disney comes out swinging with its new streaming service, and investors like the strategy, sending the stock to a record. On the rise, gas prices have been heading higher, and drivers are feeling pinched at the pump. Those stories and more tonight on Nightly Business Report for Friday, April 12th. Good evening, everyone, and welcome. Bill has the evening off. Things seem to be working in the bulls' favor. Earnings are starting off strong. Today, JPMorgan reported record profits blowing past Wall Street expectations. Then there's the merger activity. Chevron announcing a $33 billion takeover of Anadarko Petroleum. And, of course, China. Economic reports released by the world's second largest economy are showing improvement. And all of that was a recipe for a rally. The Dow Jones Industrial Average gained 269 points to 26,412. The Nasdaq added 36. The S&P 500 was up 19 and is less than 1% from a record. Bob Pisani has the details from the New York Stock Exchange.
Stocks rallied around the world today on two key headlines that support the market's bull thesis: strong earnings and strong global economic data. U.S. stock futures and European equities jumped. Bond yields rose at 4 a.m. Eastern time as China released much stronger than expected bank lending numbers and export data for March. Futures took another leg up right around 6:50 a.m. Eastern time when JPMorgan reported quarterly earnings well above Wall Street expectations. But more importantly, CEO Jamie Dimon said that, quote, even amid some global geopolitical uncertainty, the U.S. economy continues to grow. Employment and wages are going up. Inflation is moderate. And consumer and business confidence remains strong. This all plays into the bull scenario. China is bottoming. The U.S. economy will remain strong from here. So far this earnings season, more companies are beating estimates than usual, and they're beating them by more than they usually do. 29 companies have reported for the first quarter so far. Of those 29, 83% are beating estimates. That's a lot more than usual. And they're beating by an average of more than 7 percentage points. That's far higher than the usual 3.5 percentage point beat. Why is this happening? Because analysts dramatically cut their estimates back in December are concerns of an imminent global meltdown, which has not happened. So here's the bottom line. Dimon's comments have lessened fears that a recession is around the corner, and there's a good chance we will avoid seeing the S&P earnings go negative for the first quarter. It means no earnings recession. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So let's dig deeper into those bank earnings. JPMorgan, the biggest U.S. bank by assets, benefited from higher interest rates in its most recent quarter, and that helped boost operations at its retail lending business. Shares of the Dow component climbed more than 4 points. Wells Fargo topped Wall Street expectations and reported a rise in first quarter profit thanks to lower expenses. But shares of the bank drifted lower after the CFO offered a tepid outlook for what's called its net interest income, which is the difference between what a bank earns on loans and what it pays on deposits.
We make a lot of net interest income by reinvesting in our bond portfolio, and we're probably 100 basis points down from where we were in the fourth quarter. And the temporary nature of that, or the possibility of that being more temporary, seems like it's off the table. And so we understand that we'll be reinvesting in a flatter and lower yield curve environment.
The stock fell more than 2.5% in today's session. Let's turn now to Scott Seifers to talk more about the bank's earnings. He is a bank analyst at Sandler O'Neill & Partners. Welcome, Scott. Nice to have you here.
Hey, Sue. Thank you for having me.
What's your overall opinion? I mean, Wells Fargo came in better, even though obviously the guidance was not as good as the market would have expected. But
Yep.
JPMorgan seems to be firing on all cylinders.
Yeah, and I would say the same thing with PNC, which was the first large regional bank to report this morning as well. For the most part, I think what we're learning is that we had been cutting expectations for the better part of the last couple of months, and perhaps we were a little too punitive.
Now, what about the loan and lending side of the business? Some of that obviously is dependent on where interest rates are going, but that seemed to be a bright spot for almost every bank that's reported.
That's exactly right, particularly on the commercial side, Sue. What we're seeing is there was all this capital markets dislocation in the fourth quarter that allowed the traditional banking space to recapture some market share, and it looks like they've sustained or retained that market share here into the first. So that's definitely a bright spot for the group.
Which one are you going to be watching that we still have to hear from? I think Bank of America is kind of a broader swath of the economy that we might get a better read on.
Yeah, that's an excellent point. I think for U.S.-based investors, B of A kind of retains the position that Wells Fargo used to, which is to say it's probably the best broad indicator of the health of the U.S. economy, whether it's the traditional sort of Main Street consumer or you even have the large capital markets component as well. So in the U.S., B of A is definitely the one that people will be watching. And then we'll have a whole swath of regionals reporting over the next couple of weeks as well.
How do you expect the regionals to do?
Generally pretty well. PNC is probably the best indicator so far. I think what you'll see is loan growth helping to overwhelm some flattening or, worse, potentially some compression in net interest margins. But overall, the group has a lot of capital management opportunity and a lot of expense leverage as well. So we generally feel good about the group.
All right. Well, we're off to a good start. Scott, thanks so much.
All right. Thank you, Sue.
Scott Seifers with Sander, O'Neill & Partners. And Disney shares are having their best day in a decade. This after the company late last night unveiled the details of its new streaming service that will push the company into the already competitive online video market. But investors like what they heard, sending the stock up more than 11%.
We're starting from a position of strength, confidence, and unbridled optimism.
Unveiling its Disney Plus streaming platform at a shareholder event, CEO Bob Iger shined bright lights on the future, turning the Mouse House into both a content creator and a content provider, a shot across the bow of streaming providers like Netflix. When it launches in November, the Disney service will cost less than Netflix at $6.99 a month. Disney Plus will open with 9 new pieces of content, building to 25 originals within a year, from the likes of the Disney Channel, Marvel, National Geographic, Pixar, and Lucasfilm. Adding new content to libraries containing 7,500 television episodes and 500 movies, Disney says it can sign up 60 to 90 million subscribers in 5 years, and 8 to 12 million on its ESPN Plus sports service. It still owns a share of Hulu, estimating another 40 to 60 million paid subscribers there. Moves Iger believes will strengthen Disney's connection with consumers.
They're going to movies in movie theaters. They're renting or downloading movies in their home. They're buying consumer products. They're visiting our parks. They're sailing on our cruise ships. And I could go on and on. If suddenly your customer relationship is much tighter, if the proximity between you and a customer is better, then you're going to serve them a lot better across your platforms, and you'll monetize, that I'll call it broadened, deepened relationship.
Some say its subscriber projections may be too aggressive and wonder if they can replace revenue being lost by Disney's traditional cable offerings. But the stock price spike has investors and industry insiders looking to better times ahead.
And I think that Disney Plus will now be the must-have streaming service that you need.
I think they did a terrific job on Disney Plus.
What we're really seeing now, this digital revolution entering a more mature phase, is transforming all of entertainment.
Bob Iger also confirmed that he plans to step down as CEO in 2021 and that the company is continuing to develop a plan to find his successor. And now to that major energy deal that we mentioned earlier. Chevron will acquire oil and gas driller Anadarko for $33 billion, making this one of the biggest energy sector mergers in years. The transaction will expand Chevron's operations in the shale region, and some analysts call it a transformative moment for the second biggest U.S. energy company. And the CEO says the deal makes a lot of sense.
We've been, looking as our company has strengthened its financial position here over recent years. We're always looking to make our portfolio even stronger. So this takes a great company and makes it even better. It really plays to our strengths in shale, deep water, and natural gas. It'll allow us to continue to win in any environment and deliver great value for our shareholders.
But there's a twist to the story. According to CNBC, Occidental Petroleum attempted to buy Anadarko and was prepared to pay $70 a share, more than what Chevron paid. Anadarko shares soared 32%. Chevron and Occidental fell. Joining us now is Rob Thummel, portfolio manager at Tortoise Capital Advisors, to talk more about the deal. Welcome, Rob. Nice to have you here.
Thank you, Sue.
Do you like this deal?
Yeah, we think it's a great deal for both parties, basically. Look, the energy industry is going through a transformation. It's going to build a mountain of cash flow over the next several years. Consolidation, building scale, reducing operations and operational expenses are really a key to help bring investors back to the energy sector, because there's a lot of great things going on in the U.S. energy sector. The investors just haven't rewarded that yet.
Not yet. But you own both of those stocks, correct?
That is right, Sue. Yeah, we own a little more Anadarko than we do Chevron, but we do own Chevron as well.
Now, the deal making in the oil and energy sector hit a 10-year low in the first quarter because of the steep drop in oil prices. Do you think we're going to see more deals now that oil has really reversed that trend?
You know, I think what you have to look at right now, the industry is ripe for consolidation. And the reason I say that is because Exxon and Chevron want to get into places like the Permian Basin and use that as a growth engine going forward. They trade at higher multiples than some of the real independent companies like Pioneer, Concho, Diamondback Energy. So there's a natural opportunity for the higher multiple companies to buy the lower multiple companies and for it to make sense for all shareholders involved. So I do think we might see a trend that's starting to emerge here.
Yeah, and we should note that some of the biggest shale companies were sharply higher today. They're anticipating that more deals will be done. How much of this is going to have to depend on oil staying at the price that it is now, or perhaps even higher?
No, we don't necessarily need oil prices to go higher. Just need them to stay stable. Where we are today, plus or minus $5, is a great spot. One of the great things that's been lost is that the U.S. energy sector has reduced the cost to drill oil significantly. And that's a great thing for consumers, because that means, we keep energy costs to consumers in the U.S. lower, as well as costs around the world are much lower as well. So the U.S. energy sector has done a great job of producing significantly cheaper oil, which is a great thing for all consumers, whether you're here in the U.S. or somewhere internationally as well.
If you're a long-term investor, should you delve into maybe some of those oil shale stocks or others in anticipation of this consolidation continuing?
Yeah, at Tortoise, we're recommending essential assets. And so we think shale stocks are essential assets. Shale is going to be where the growth is in terms of production. We also like energy infrastructure as well. If you think about there's going to be a lot of production, you're going to need more energy infrastructure. These essential critical assets are necessary to transport that energy as well. So we think the energy sector is undervalued, and there's a significant opportunity to buy a lot of stocks across the energy value chain.
All right. On that note, Rob, thanks so much for your perspective. Rob Thummel with Tortoise Capital Advisors. It's time to take a look at some of today's upgrades and downgrades. Apple was downgraded to sell from neutral at New Street Research. The analyst cites concerns over iPhone demand. The price target is $170. The shares fell a fraction to $198.87. Chesapeake Energy's rating was cut to sell at Goldman Sachs. The analyst expects the company to have less favorable returns than its rivals. The price target is $2.50. The stock fell more than 4.5% to $3.17. Martin Marietta was upgraded to buy from neutral at Goldman Sachs. The analyst cites higher pricing and more spending on infrastructure. The price target is $2.32. The shares rose 2% to $212.16. And still ahead, why our market monitor is finding opportunity in the gaming and entertainment stocks. Southwest Airlines does not plan to use Boeing's MAX jets until August, and that is 2 months longer than previously announced. Analysts say American and United will likely follow. Separately, the FAA met today with airlines and pilots to discuss the grounded jet. American Airlines said it was confident in the direction the FAA is heading. The pilots said ultimately they need to be satisfied in the training and the software upgrade. California Governor Gavin Newsom released a number of proposals to help confront rising wildfire liabilities. One idea is to create a fund that spreads out the costs from fire-related lawsuits, while holding the state's largest utilities more accountable for the growing number of blazes. And it was the creation of the fund that sent PG&E shares up 20% in today's session. President Trump said today that he wants the U.S. to win the race to develop 5G infrastructure.
5G networks will also create astonishing and really thrilling new opportunities for our people, opportunities that we've never even thought we had a possibility of looking at. We cannot allow any other country to outcompete the United States in this powerful industry of the future.
His comments come as the FCC discusses opening up spectrum for the next generation of wireless technology. The head of the agency says it will be allocating more spectrum for commercial 5G than all of the mobile broadband providers in America have today combined. The FCC also announced a $20 billion commitment for high-speed networks in rural areas. Jumia is the first African startup to list on a major global exchange, and that's where we begin tonight's market focus. The e-commerce company began trading on the New York Stock Exchange and is often referred to as Africa's Amazon. Jumia sells goods and services online. It operates in 14 countries. It has 80,000 active merchants, and according to the CEO, it has a uniqueness that sets it apart.
The uniqueness of Africa is for the sellers. It's very hard to distribute their products because of the inefficiencies of Africa and the challenges that the infrastructures present. And with technology, we have built a platform which is very effective for the sellers to distribute their products and for the consumers to shop. In Africa, there's very little retail. And the solution is to go online and go on Jumia.
Its shares priced today at $14.50. Today it rose 75% to $25.46. PNC Financial reported profit and revenue that increased in the first quarter. The regional bank more than doubled its provision for credit losses, which its CEO says is due to solid loan growth. He also added that overall credit quality remains strong. The stock was up 3% to $132.70. General Electric will pay a $1.5 billion civil penalty to resolve claims related to subprime residential mortgages. Those loans were offered by its WMC unit. The Justice Department had alleged that GE and WMC misrepresented the quality of those loans in connection with the sale of mortgage-backed securities. The shares fell 1% to $9 even. Bristol-Myers shareholders approved that company's $74 billion acquisition of Celgene. More than 70% of eligible shareholders voted for that deal. The acquisition has drawn pushback from institutional investors, saying there was too much risk involved. The deal is expected to close in the third quarter. Both stocks were lower in today's trading session. And the maker of a migraine medicine is reportedly exploring a sale. According to Bloomberg, Biohaven Pharma has attracted takeover interest. The company is expected to file a marketing application for its oral migraine treatment. Shares rose about 20% to $58.24. And Allegheny Tech warned investors that first quarter results would come in below expectations. The CEO said the maker of specialty materials faced unexpected headwinds like higher operating costs and lower demand for some products. But he added that things are expected to improve in the second quarter. Nonetheless, the shares fell 5% to $25.66. Time now for our weekly market monitor, who is betting on the entertainment and gaming industry. He has names he says you'll want to own for the next year. Joining us is Ross Gerber, CEO and president of Gerber Kawasaki. Welcome back, Ross. Nice to see you again.
Thank you.
Let's start with Disney. Obviously, big news on that stock today. It hit a new record. Why do you like it longer term?
Well, I've owned Disney my whole life, so to be honest, it's just a lifer kind of stock. But Disney's finally made the 21st century transition into streaming, and they've done it in a huge way. And by taking control of Hulu and Fox assets, combined with all of the Disney assets, they've produced I think, the greatest app I've seen since Netflix. And at the price point that they started out at, $7, it's just like a must-have for families across the world. So this is a huge move in the right direction for Disney, and it's irrelevant of the fact they have the best movie slate I've ever seen coming out. And all these movies are going to be on the app when it launches over the next year. So, it's really an amazing product they've created. So we're more bullish now. We were bullish on Disney for the last period of time. We've waited for several years for the stock to move higher. It's doing it now. It's a great, great time to be involved with Disney.
All right, sticking kind of with that theme, but going globally, we go to Tencent.
Yes, so Tencent is really the most interesting and dominant tech player out of China, with a lot of investments throughout the world, including an investment in Tesla. But they own Riot Games, and they own part of the company that owns Fortnite. And so they're well entrenched in the video gaming business, and in Asia, that business is huge. They also own part of a company called Hoya, which is the Twitch of China, which is also growing like crazy. But most importantly, they own the operating system on most phones in China called WeChat. So Tencent is a wonderful investment.
All right, next, MGP. It's MGM Growth Properties. This is a REIT.
Right. This is a REIT that owns the land under MGM hotels in the United States. And it's a wonderful investment because you have the safety and security of owning real estate, and yet you're getting a yield of almost 6%, about 5.75%. And with a rising dividend yield and interest rates moving lower, the spread between this yield and the yield on a 10-year Treasury is very, very large for what a safe asset this really is. So we look at this as a great way to get extra income, rising income, and some benefit, obviously, from the growth of gaming and Las Vegas as they get sports and a new stadium and online gambling. So we're really bullish on this because interest rates, we think, are going to continue to go lower over the next couple years.
On that note, Ross, thanks so much.
Hey, thank you for having me.
Ross Gerber with Gerber Kawasaki. Coming up, filling up and paying up.
At gas stations across the country, drivers are feeling the pinch at the pump. I'm Rahel Solomon for Nightly Business Report. Coming up, I will tell you what's behind the increase and also when we can finally see some relief.
Here's a look at what to watch for next week. Earnings will be in focus with companies like Goldman Sachs, Citigroup, Johnson & Johnson, and Netflix all reporting their earnings. The major automakers will show off their high-tech vehicles and concept cars at the New York Auto Show. Economic data, including retail sales, housing starts, and the Fed's Beige Book, is also due out. That's what to watch for next week. With just a few days until the tax filing deadline, an early look at the data shows average bills are dropping. H&R Block reports that its average customer paid $1,200, or 25% less in federal tax in 2018 compared to 2017. The report is based on returns filed through March 31st, and it provides a first look at how the biggest change to the tax code in 30 years is impacting filers. Well, on a day that saw a $33 billion energy deal, oil prices climbed to a 5-month high, settling at about $63 a barrel. As you're aware, domestic crude has been rising since the start of the year, up 40%. And that also means it's costing you more to fill up your tank. Rahel Solomon is in Fort Lee, New Jersey tonight.
If you feel like the cost to fill up has been creeping higher, you're right.
I would normally fill up regular like $30.
And how much was it today?
40.
I actually drive Uber, and the last time I checked in this particular gas station, it was like $2.65, and all of a sudden I see this. Surprisingly enough, it was like 10 cents more.
I want to be more conscious about the way where I drive because I can't really afford to go everywhere I would like to go.
The average price for a gallon of gas has steadily risen since the beginning of the year. According to AAA, the national average today for a gallon of regular unleaded is $2.81, about 12% higher than a month ago, and nearly 4% higher from a year ago.
The price of oil continues to put pressure on gas prices, jumping to a 5-month high, now at about $63 a barrel.
Patrick DeHaan of GasBuddy.com says there are several factors to blame. One is refinery disruptions because of maintenance, both planned and unplanned. Another factor for states out west, March's destructive flooding in the Midwest. The severe weather damaged railways that transport ethanol that blended into gasoline to meet environmental regulations.
Anything flowing through Iowa and Nebraska has been a challenge. Iowa mainly, the U.S.'s largest state when it comes to ethanol production. So those trains have found it difficult or very challenging at best to get to the West Coast.
In fact, 5 of the 6 most expensive states to buy gas are west: Oregon, Washington, Arizona, Nevada, and California. In some places like Los Angeles, they're paying more than $4 a gallon for the first time in about 5 years. Summer to summer, analysts say expect this year on average to be slightly cheaper than last year, with June being the most expensive month and September being the least expensive. So expect prices to tick a little higher before we finally see some relief. For Nightly Business Report, I'm Rahel Solomon in Fort Lee, New Jersey.
Finally tonight, SpaceX giant rocket called the Falcon Heavy launched into orbit and stuck its landing. It was the second launch for what is the most powerful rocket in operation today, but it was the first launch carrying a commercial payload. The satellite it was carrying will provide telecom services to the Middle East, Africa, and Europe. One more Falcon Heavy flight is scheduled for this year. Before we go, here's a look at the final numbers on Wall Street. The Dow gained 269 points. NASDAQ added 36. S&P 500 was up 19. The week saw just modest moves, but it was the third straight up week for the S&P. That does it for Nightly Business Report. Thanks for joining us. Have a great weekend, and we'll see you on Monday.